Assalamualaikum warahmatullahi wabarakatuh. My name is Aisyah Hadira binti Haslan, metric number 050881, and I'm from group 17. The topic that we are going to present today is Islamic banking and finance institution. So, first of all, we go to the introduction. What is Islamic banking? Islamic banking is known as non-interest banking. Is a banking system that is based on the principles of Islamic or Sharia law and guided by the Islamic economy. So there are two fundamental principles of Islamic banking, which are the sharing of profit or loss and the prohibition of the collection and payment of interest by lenders and investors. In Islamic law, prohibit collecting interest or usury, or we call as a riba. Next, we go to the what is finance institution. Finance institution is a company engaged in the business of dealing with financial and monetary transactions. So, in financial institutions, surround a broad range of business operation within the financial service sector, including banks, trust company, insurance companies, broker firms, and investment dealers. Virtually everyone living in a developed economy has an ongoing, at least period, need for the service of financial institution. So we go to the next one, which is Islamic finance may be a term that reflects monetary business that is not contradictory to the principles of Sharia. And conventional finance, significantly standard banking business, depend on taking deposit from and providing loans to the general public. Islamic banking is the foremost important underlying principle of typical banking that cash create money or that cash include a premium known as interest or usury, or we call it as riba. So we go to the next slide, banking and interest or riba. Islamic banking is branch of Muslim finance that conjointly the branch of finance that needs to be viewed from a unique perspective because it cannot replicate typical banking. As cash on its own cannot earn cash, a link must be introduced between cash and profit as another to interest. So it's again this background that Islamic banking has been primarily concerned in the commercialism, leasing and fee-based transaction, furthermore as investment activities. Okay, we go to the next one, commercial bank. Commercial bank is collect fund from the community and extending credit, which is making loan to people for useful purpose. And the commercial bank has two, which are source of commercial bank funds, and the second one is investment by commercial bank. Source of commercial bank fund is bank helps people spend their money more efficiently and invest our saving more wisely. And the keystone source of funds for most banks are demand deposit time and saving deposits. And the second is investment by commercial bank. Commercial bank put their deposit money to work by making loans and buying bonds. So there are important of investment, which are commercial loans, state and local government bond, and United States government bonds.
The investment bank. The first one, investment bank is the intermediary activity carried on by security firms and commercial bank in the sale of new security. Investment bank divide into two. The first one in distribution of investment. The investment banker distribute the issue to many investors to sell the issue quickly. A syndicate of many firms informed for each issue. And the security are distributed to a large network reaching many potential investors. Firm in the syndicate sell the new issues as an alternative to existing security that they buy and sell. The investment banker want to sell their inventory of underwritten securities so that they arrange more new issue. A high volume of new issue is a key to investment banking success. because fees are based on the volume of security sold. Ideally, the investment banker can sell a new issue within a few days after it underwriting. The second one is portfolio of investment banker and broker. Most investment bankers are also secondary broker and dealer. They are traders who maintain small inventory of security which they plan to sell in the near future. Note that the total asset of $26.6 billion in 1976 of securities broker are only small fraction of total asset of any of the thrift type institution. Sources of financing are principally commercial bank loans and customer credit balance. Commercial bank extend broker loans, which are very short-term credit collateralized by marketable securities. Customer credit balance are amount due to brokerage customer and arise when customer deposit money or fund delivery are held after customer securities are sold. Many customers prefer to leave credit balance at brokerage firm to pay for future securities transaction, and brokerage firm accept the fund as a short-term sources of financing. Finance company loan money to customer and business with specialized loan arrangement. Loans are granted directly and usually meet specific need of the borrower. Generally, it can be identified to the type of finance company. According to the type of loan they grant, the first one is sale of finance company. Sale finance company develop profit potential of consumer lending by fostering close relationship with durable good retailers. The retailer write the loan at the point of sale, but the finance company specify the maturity, down payment, changes and other terms. The retailer says the loan to the finance company. Loans are purchased in three bases, which are full resources, non-resources, and repurchase. The second one is business finance company. Business finance company loan money to businesses to finance account receivable, inventory, and fixed asset. Account receivable are financed frequently with security. Secure loans are backed by a pledge of account receivable owed to the borrower by its customer. The last one is personal finance company. The unique aspect of personal finance company are they deal directly with consumer and grant cash loan. The purpose for which these loans are granted included purchases of automobile, appliance, recreation vehicle, vacation, education, and consolidation of debt. Personal loans are categorized according to whether they are durable goods or cash loan. Takaful Operator Company. Takaful Operator Company established by government in 1982 to review the viability of fitting of un-Muslim insurer and also following recommendation of Takaful Act 1984. Takaful Operator Company supported by Malaysian government in business enterprise pointer for international takaful operator. Its objective is to boost the capability of takaful operator and strengthen the legal, jurisprudence, and regulation framework.
Fund manager company is responsible for implementing a fund's investing strategy and managing its portfolio tracking activities. Quality Management Corporation is conventionally known as Cash Manager or Cash Management Corporation, whose provide public funds or change trade funds and mutual funds. However, there are non-public quality management. For example, RMB Capital, a freelance investment and consulting firm with close 8.8 billion in assets beneath management. Saving and loan mutual saving banks and credit unions specialize in consumer savings account and consumer mortgage loans. Other than that, service intermediaries attract small amounts of individual money who want a safe place to put their money. Also, saving intermediaries specialize in making loans to consumers for houses, cars, furniture, and appliance travel emergency expenditure. Number of service household saver, transmutation of long-term mortgage loans and bonds to short liquid term deposit. Division of financial assets into convenient denomination. Transaction convenience, reduction of risk, dissemination of information on rates, terms, and other information. A major service of saving intermediaries is the transmutation of saving dollars into long-term loans. Savers often want to keep their money in short-term securities such as saving deposit in 90-day and certificate of deposit. On the other hand, consumer and business usually need long-term loans such as 36 months auto loan, 7-year equipment term loans, and 30-year real estate mortgage. These thrift institutions satisfy both savers and borrowers by issuing deposit type instruments and purchasing longer term securities.
As you can see, a pension plan is a fund established and maintained by an employer, union, or individual to provide for the payment of definitely determined benefits to people during the retirement. Several aspects of definition are important for pension fund management. First, there is a written plan which specifies who participates, benefits, and administer the pension fund. Second, benefits are contingent on retirement from active employment. Third, the benefits are definitely determinable now. Future benefits are determined by a frame contract and are not subject to the whims or fortune of the employers or union. Contributions are invested in a portfolio of income producing assets during the employee's working years. The portfolio of investment usually, but not always, increase value and rate of return may vary widely. The performance of the investment portfolio depends upon the return produced by securities selected for the portfolio, whether the employee, employers, or insurance company benefit from expect to the large return or suffer losses from expect to the small return depends upon the type of pension plans. Subject discussed later. The type of contact fund used to pay benefit is defined benefit and defined contribution. In a defined benefit plan, the retirement payment and contribution are estimated by an actuary. For example, the plan may call annual benefit equal to 60% of the employee's last year's salary. The actuary estimate how many people will be retiring and their salaries in the future years. In this case, the benefit is not fixed dollar amount, and the actuary makes exception about the future wage and salary rates. On the other hand, the plan may call specific contribution, such as 8% of wages and promise retiring, a share or the resulting portfolio. As each contribution is added to the pension fund, the employee receives units which entitles him or her to share at retirement age. The share value depends on the performance of portfolio and is not guaranteed by anyone. In defined contribution, plan pass investment to the participants. Thus, in the case of defined contribution funds, the retirement benefit depends of future market conditions. Pension fund growth. Pension fund growth. Pension funds are growing rapidly from substantial new contributions and the reinvestment of investment income. This section looks at the growth of pension fund in general and for specific institutions. They divided the pension funds into three groups. Number one, private plans, consist of insured and non-insured type of content discussed previously. Second, government administered plan, the state and federal employees retirement plans. Third, old age survivor and disability insurance, that commonly referred to social security and provide welfare transfer to a large segment of population. This slide, for the last slide, I'm going to tell you a little bit about economic development institutions. The expression institutional financial matters was first utilized by American market analyst Walton Hamilton at the meeting of American Economic Association in 1918. Institutional financial analysts see the market as a social organized as opposed to the classical financial methods. Market interests assume a key job. In 20th century, conventional institutional methods was planted by increasingly well-known new institutional financial expert, NIE, which attempt to incorporate new hypothetical bits of knowledge. For example, the hypothesis of associations, exchange costs, position rights, and so far into standard new classical financial methods. NIE, or we call new institutional financial expert, depends on comparable hidden suppositions that takes into nature which specialists work and give NIE extra logical force. That's all from our group. Thank you for the listening.